welcome to Global Mantra Outlook 2013, a special show that profiles prominent fund managers from the City of London and gets their views on the global market environment. Joining me on the show right now is a very special guest, Nusseibeh, who is the CEO of Hermes Fund Managers. Thanks very much, Mrs. Nusseibeh, for joining us. First up, really, you've given out this explicit note on the political risk that world economies face in the year 2013. Your base case scenario is that the US is going to go off the cliff?
That's my basic scenario, and it's just mine. I was talking to somebody who was one of President Obama's previous economic advisors, and he knows Washington much better than me. And when I said to him, but come on, the politicians can't be that mad. And he said, really? Have you been to Washington?
So what would that really mean for the markets?
I think that you might see a downgrading of the US. I think, of course, it will affect the bond market in the US for a while. But the bond market in the US remains unassailable for the time being because there is no other alternative. The problem is, what else is there as a store of value? There's nothing. There is the US dollar. Yeah. People have gone off
treasuries?
the story of the treasuries, exactly. So people continue to buy treasuries. The euro is no longer a story. People are still scared about the euro. China has come off the boil. There's a limit to how much gold you're going to buy. The long-term economic story of the United States remains very strong. I mean, the recent reports coming out showing them to become the largest producer of oil in the world is quite stunning if you think about it. That means that they can become almost completely self-sufficient and almost isolate themselves from the rest of the world. So long-term, the economic forecast for the United States is good, and short-term, therefore, people will not like going through the cliff. They'll panic on the day, and then they'll see a compromise coming very quickly thereafter. So I'm a great believer they'll solve it. It's just how they solve it. The market thinks they'll take it to the brink and solve it just before it goes through the brink. I sort of think they'll go through the brink, then solve it and come back, and it doesn't really make a difference.
So, but for 2013, would that mean negative growth for the US economy?
I don't think so, because I think they'll solve it quite quickly. I mean, the US is not going to have the old growth of 3%. 4%, but they will have 2%, 1.5 to 2%, and 2% is much better than people have here. Several reasons. First of, manufacturing continues to pick up in the US. Secondly, we're beginning to see a recovery in the housing market. It's anecdotal and sparse, but it's there. Therefore, you would expect to see some beginning of rehiring in particularly the construction industry. That will add to the job market demand. You add to that the Fed's underwriting, essentially, of almost continuous easy policy until the economy picks up, and they've linked it specifically to unemployment. They're saying at this stage in the recovery, unemployment should be 1 full percentage points lower than it is at present, and until it hits the trend, they're going to keep on easing. That reminds us of the policy of the Fed in the late 30s and early 40s, when the Fed was not independent, was part of the Treasury, and did exactly the same policy. So it all points, at least the Americans are doing the things the right way. They've written off the debts of the banks. Lots of banks there have gone to the wall. The property market has devalued, lots of value destroyed. That's the bubbles come out of it. They're beginning to pick up from manufacturing. A lot of people forget the US manufactures things and has a lot of self-sufficiency. The one weakness it used to have, its dependence on importing energy. It looks like that's going away. It changes the picture.
What would that mean for risky assets, emerging market equities per se?
I think people are going to be guided by two factors. One is what happens in China. We now have a new election in China and a new government elected. We're still not entirely sure what that means, and we will only find out in time. There were indications that part of the old party hardliners, in fact, reasserted their strength, if you like. They do have social problems, as we saw with the strikes in Foxconn factory. We do know they're trying to squeeze the top end of the market, and we do know they have something which looks like and smells like and feels like a credit crisis or a banking crisis. Now, they're going to control that and slow that down, and people will want to see how that plays out. That's one side of the emerging markets. The attraction to everybody else is growing 5%. That's still better than everybody else. The other side of the equation is Brazil, which was the darling of the Latin American part of the emerging markets. And there, what we've seen is a lot more government interference than people were used to. We spoke as in Hermes about political risk in our paper, and one of the issues about political risk is that governments under threat will decide to interfere in the economy and in society to try to smooth the political situation. And to ask what the Brazilians are doing is doing just that. Now the problem with that is the market has reacted rather badly. So far this year Brazil is down 10%, for example. China's up 10%, which gives you a length of it. But people will focus again on China, and I think they'll rethink about risk assets. I think if the United States goes through the fiscal cliff and things turn out to be better than one expects in the United States, that's a bullish signal for emerging markets because all risk assets will try to go up.
So what to your mind would be the biggest risk for 2013?
I think the crisis still remains centered on Europe, and I think the issue, I mean, the euro is just a tag that you can put around it. The issue is that to try to save the euro has led to policies which are highly deflationary, ultimately. And that has led to a huge amount of hardship for ordinary working men and women, particularly in Southern Europe. We saw yesterday concentrated strikes across the whole of Europe. We saw in Spain, for example, the banks taking the decision not to evict families who have fallen behind on mortgage payments. That's a big thing because the Spanish people were getting rather upset about it. We saw in Greece that the Greeks simply cannot keep with the austerity measures. There's an anger at the Germans and their obsession with austerity. So there is that fault line, and the fault line in Europe is real, which is whatever the economic scenario, the people, particularly the people of Southern Europe, are saying enough, we can't take it. Now, we're beginning to see signs that France might also be hitting some hard times. If the French economy also hits some hard times, then we have to ask ourselves, will the French impose the same type of austerity on their people that they've been asking the Spanish government and the...
You think austerity will be the reality for tomorrow?
I think austerity is what clearly the Germans want the rest of Europe to do. I'm not entirely convinced this is the right way forward, no. I mean, I know that in this country...
What would be the middle path then?
The middle path would be some expenditure, I think, which is what Maynard Keynes said so many years ago, that partly you pump money to the economy to make it grow.
The investment cycle is not picking up,
yes.
And you know, this is despite Mario Draghi's commitment that he'll do whatever it takes to really ensure that the euro survives and the countries stay together.
Absolutely. So Draghi is saying, effectively, that's exactly what we'll do. We will ease. The problem is that Draghi speaks for himself and he's trying to convince the politicians. My economist has a wonderful phrase. He says the euro is a currency in search of a government. That is partly the problem that Draghi has. So that he's going to have to go and convince all the governments that he can, in fact, pursue his easing policy. And I'm not entirely convinced that he can. I mean, he says that he will.
Because that comes with the risk of increasing debt for the balance sheets of all these countries. For the balance sheets
of particularly the northern countries. And at some stage, you know, look, all bubbles, and we had the mega bubble in 2008, are ended by the destruction of assets. The asset that has to be destroyed is wealth. The southern countries don't have wealth. Right? Now, the northern countries are upset that it's their wealth that has to be destroyed, but something has to go.
So what is the biggest risk that you see in Europe? What could be a negative for the market in this year?
That essentially you get the popular level, or a popular level, particularly in Spain, but possibly in Italy, people saying no, we will not take austerity, I don't care, and pushing their governments to saying no. It almost happened. I mean, Rioja is...
Would that mean that the risk of sovereign defaults rises in Europe?
Yes. And the reason you can't quite game against that is because we sit here in the city and in financial centers around the world, and people talk about economics and logic. There comes a stage where people become very emotional, and if they're pushed to the edge... Now, in Greece, it didn't quite work because Greece is small to some degree as a country. They had a lot of rupture, but they felt threatened. At some stage, this picks up momentum, and people just say, we will not accept this. And once they say, we will not accept this, the politicians can't do anything. I mean, they can try to force them, but then that's the end of democracy, sort of. I think, I'm not saying that risk will happen, I'm not saying defaults will happen, I'm saying that the risk of defaults is there. I think the lesson of this year has been that people have woken up to the fact that emerging markets are not separate from developed markets, that the growth in emerging markets is dependent on the growth in developed markets, ultimately. Now, on the positive side for emerging markets, I think the growth in the United States is surprising on the upside and will continue to surprise on the upside, and that's good. That's half the world economy. The negative side is that people are assuming, I believe, that somehow the European crisis will be resolved. I do not think that the market genuinely is factoring in, again, the possibility of default. It goes and comes. But at this stage, today, as we look at the prices, they sort of believe Draghi, they sort of believe that everybody's come to a solution, and so that's come out of the equation. If that comes back into the equation, people will again question where the growth is going to come for emerging markets. That's one. The second one is, before we came on air, we were talking about China. People have to factor in how the Chinese new government achieves the slowdown in the economy. They're going to achieve a soft landing because they control it. But we have to find out what the policy is.
2013 will be a good year for China, you think?
I think on balance, yes. I think on balance, yes.
What about India?
And what about India? So India has a lot of things going in its favor, I think, and some things which were playing against it. Short term, there were still some issues about corruption that the government is not seen as tackling strongly or quickly enough. The new minister for finance is seen as a good minister for the markets. That's been taken positively. But India still has a major problem, which is that India needs infrastructure. And that needs to be invested, and it needs to make itself more attractive for both direct flows and portfolio flows to help build this infrastructure for the Indian economic story to really take off.
But even if the government puts pushes the infrastructure sector forward, they open windows via the bond markets so that foreign investors can invest in infrastructure. There are no takers for that paper.
Not yet, because India is not, it has some way to be seen as being absolutely friendly to foreign investors. And it's a long road, but I mean, clearly there's enough interest, but they need to do some more. They need to tackle corruption some more. They need to make it, the whole environment more friendly to foreign investors a little bit more, and they'll do that. It just takes time.
So, India has moved from underweight to neutral this year. Not on a consensus basis, but a lot of funds have increased their allocations to India. In 2013, how do you see fund flows panning out, and how do you see India's position within emerging markets?
I think it'll continue to do better than Brazil. That's clear, because what the government is doing in Brazil is scaring in foreign investors. I think there'll be a tug between whether the flows go to China or they go to India. I mean, I'm talking about the big blocks within the markets. And possibly because India's done so well this year, some more flows will go to China than to India. But I think India still remains attractive.
What about political risk in India?
Less so than elsewhere, because India at least has, for all the corruption, for all the elitism, for all the attacks on cronyism, it does have, and by the way, for all the insurrection in parts of India that people don't hear about, it still has a functioning democracy. And a functioning democracy is a stable mechanism. The reason why I doubt the functioning democracy model in a place like Spain is simply because the majority of the people are not happy with the rule of their elite, and that is where you feel with the fear a backlash. In India, it functions, it gives it more stability than other emerging markets for sure.
So on balance, do you think that in 2013, on a relative basis, between India and China, allocations, incremental allocations will move more towards China?
I think on balance that's what should happen. You can never underestimate the ability of investors to invest on last year's story and therefore to allocate more to India on the basis it's gone up even more.
Right.
But I think on balance that's what they should do, because they should feel more comfortable about China. On a relative basis, India have done better this year. They'd allocate to India, but they should allocate a bit more to China.
But are you more optimistic about India?
I've been more optimistic about India for a while. I am, and I do think it's partly because it has the resilience to go through. I'd like to see more infrastructure. I mean, that would make me very bullish on India, but not yet.
But do you think that India can double up on the gains that it has made in 2012?
I think it can go up some more. I mean, I think it can go up some more because the situation is not bad. It will grow 5%. If it doesn't do the 5%, then you have a problem. But if it does hit the 5%, if inflation roughly remains where it is, India would be fine. And therefore you see more flows to India and the market will go up some more. My argument is probably they'll allocate more money to China.
Sakar, let's talk about the opportunity set that you see in 2013. Where are you betting?
I think go to where people are not betting. Most people have completely given up on the possibility of a strong US recovery. I think they're wrong. The US will surprise on the upside. You have to wait till after the fiscal cliff. Once that happens, I think people will start to rethink about equities for two reasons. One is that in an environment of very low yields, equities do give you a return that is better than inflation. You have companies with strong balance sheets, a growth that's linked to the economic growth of the country. I think people will start thinking about equities the way they thought about them at the beginning of the 20th century. which is about dividend flow rather than the way they thought about them in the 70s, 80s, 90s and noughties, which is about capital gains. That is a different kind of equity rally from the relief rally we saw in Europe. To my mind, that rally would be a beginning of a change in mentality about how they treat equity versus bonds. What we've seen is the split of assets into risk assets growth assets and matching assets. We've seen people trying now to find ways in which they can create some kind of yield return through all sorts of contortions. But the simplest way to do it is look at companies that have strong balance sheets, world-class businesses, and these are clearly going to grow their earnings. And
would that mean that the second half of 2013 would perhaps see more allocation to equities?
I think so. I think that will be the beginning of more allocations to equities. Remember, we've had more than 10 years of bear markets in equities in developed markets.
But where would money flow within equities? US equities, emerging market equities?
I think US equities, and through that they go back to emerging market equities. I think where I find difficult to see money flowing is European equities at this stage, except for if you're a European investor. If you're a European investor, it makes perfect sense because it's your own market. The same reason that you play the dividend play in the US, you play it within Europe. But if you're a foreign investor, probably go for the United States and then you go to emerging markets.
What about safe haven assets in 2013? Dollar, gold, US Treasuries?
I mean, the US Treasuries remains the safe haven asset, but now it gives you a negative return, so you have to pay for the safe haven element. I don't see that the dollar and the Treasury will change. Well, the dollar is interesting because, of course, the United States has devalued its currency quietly without people realizing, which is partly why it can export more. I think the Treasuries remain safe haven. I think at some stage people will look, and that's why I'm saying US equities. It sort of is in the US, therefore it's safe. It sort of will give you a return, which is an equity return, which is sort of safe. Some of the other assets that people have invested in, I mentioned the bubbles in real estate assets at the mega rich element. That must break. That must break, and you see flows out of that at some stage.
What about gold?
Gold you can. I mean, the problem with gold is nobody really thinks of it as a currency, and the price is so high now. There is no inflation, which is typically why people would buy gold as a hedge against it. It does have an attraction for high net worth individuals in that they can touch it, and it's a real asset.
Do you think it can go beyond 2,000 this year?
It's difficult. It's difficult. This is not an argument that I buy. There's not enough gold to cover the currencies of the world. So no, I don't see that.
So do you expect a correction in gold price?
Some correction in gold price. A correction, some correction. It's just, it doesn't make sense.
What about oil prices? Because a lot of the EM stories linked to oil prices and energy independence, so to speak.
I need to think about that, and I haven't formed my view. The news coming out of the United States about the self-sufficiency of the United States in oil is going to change the game, because if you think about it, it means that the United States doesn't need to import anything, and therefore all the exporting capacity that used to go to the United States becomes extra capacity, so that should press the oil price down.
Exactly.
It will take some time for that to come through. It's not going to happen immediately, but markets discount to the
because
future.
that would be another positive trigger for an all-important country like India.
That'll be another positive trigger for India, and I think that will begin to come through in the next few months as people think about the implications. I don't think it's quite sunk in what it means. I mean, again, to me, that's the story of the United States, but you're right, if you're an oil-importing country, it must mean the long-term trend is a downward pressure on oil price.
Right. Give us a sense also on money allocation trends for 2013.
It depends what my liabilities look like. I mean, I think it still makes sense to have something in safe haven assets like treasuries. The current allocation generally is too high. I would allocate some to it, but not as much. I'd allocate, so no more than a third probably. I'd probably allocate, and this is very controversial, not the traditional 30 or 40%, but as much as 50% to equities which are dividend-paying equities. Which is high-yield equities. Alternatives is an interesting one. I'd allocate to alternatives if I knew what I was getting into, and there I'd buy yield plays. Yield plays can be...
What about EM debt?
Well, yield plays can be EM debts. Yield plays can be property finance. Yield plays can be private equity. Yield play can be infrastructure. Of those, I think infrastructure is interesting. I think commercial property is interesting. Emerging market debts is more of a curious egg because you cannot buy into the debt of China in a meaningful way. So really you're just talking about India plus a few other periphery countries, and that becomes a very specific question. But I think all of these yield plays is where I put my money more than I would instead of bonds. So if you like, switch some of my allocation that's normally in a bond allocation much more into an alternative yield play allocation or rate allocation, and that would be my 20 to 30%. So that's how I'm divided.
And since we're talking about equities being your preferred asset class, in emerging market equities, which are the markets that you're most bullish on and most bearish on?
I'll stick to the main blocks. I am cautiously optimistic about China because I have a lot of faith in the political system there and its ability to fix things. We might see some turbulence if they decide to squeeze the rich class a bit more, but I think they will achieve the 5% growth, and therefore I'm reasonably comfortable. I'm very comfortable with India. I think India continues to do the right things at the right place. I'm less comfortable about Latin America, specifically about Brazil, and I think that political interference, which has a long history in Latin America, has come back, and that makes me more worried about it.
And what about emerging market currencies?
That is more difficult one to say, again, because one of them, which is China, is not in free play.
Sure.
So you can't quite tell. I think it's a sideways movement until we work out what happens to the euro. And because so far all that we're really talking about is a play against the dollar. So let's wait and see what happens with the euro, and then we can make up our minds.
But stepping into 2013, are you optimistic, more optimistic than you were when we actually started off 2012?
That's an interesting question. Am I more optimistic? I am, because I think that parts of the world will do very well. However, I think you'll see a lot more disruption than people realize. But the disruption is much more on the social level, and the disruption is much more about the effectiveness of governments in Western Europe.
You think macro risks have been priced in?
I think macro risks have been partially priced in. I think at this stage people are not pricing in the possibility of a breakdown in Europe, no.
All right, Sakra, we'll leave it at that. Thanks very much for joining us and giving us your perspective
for
2013. With that, we come to the end of this edition of Global Mantrak. Thanks very much for watching.